In terms of equity market valuations, the question is, when is going to be the time to step back in? How much of a drawdown will have been enough to price in the cyclical slowdown that we all expect to materialize this year, but then also into 2023? And really, that question can't be answered until we start seeing inflation moving. We need to see inflation start coming down meaningfully for 1 or 2 months. We need some consecutive declines in inflation for people to really relax, be able to breathe out, and for Powell and other central bank governors to do another pivot to give us a bit of a pause. Because if we have a continued increase in monetary policy such that you have financial conditions getting tighter while you have this demand destruction going on at the same time, then of course the fears are really that we could be steering ourselves into something deeper than just a technical recession or a slowdown, into something more structural. Because, if you keep on with the financial condition tightening, not just interest rates going up, but also QT, so bringing down money supply, that's likely going to have some domino effects that are very serious. And then we're starting to talk about the danger of really creating something more structural than just a cyclical slowdown. So we're not quite ready yet to jump in and start buying equities again.
Dan, I don't want to wait for the official data to tell me that inflation is already beginning to cool. Surely I can look at the oil price, which we were discussing in the first half hour. We're off, I don't know, 10, 20 bucks from the recent highs. Isn't that an indicator that we're already seeing moderating or at least peak inflation at this stage?
Look, I'm afraid it's going to be more tricky than that, Jeff. I was watching the program. It's a fascinating discussion you were having, a really interesting discussion on the housing market as well. I think inflation, you're going to have to bifurcate into 2 elements going forwards. Energy, commodity price inflation is supply side led as well as demand side. That's going to be stickier than the rest of the inflation complex that we're looking at. So what I'd like to see is for the jobless rate to come up a little bit, housing prices to come down, and other types of inflation that we've been looking at to normalize. And we've already seen some of those like supply side issues already normalized. I mean, lumber has come off meaningfully. There's no talk about lumber price inflation anymore. And also, if you take a look at Baltic Dry or Harpex, things are normalizing there as well. Look at what Samsung told us. They told us their inventories are full and they're telling their suppliers to slow down with production. So I think a lot of the elements of the type of supply side inflation that we had because of bottlenecks, COVID-related reopening bottlenecks, those are going away and they're going to continue to go away. Demand destruction is going to bring the rest of this mitigating effect that we have. So a slowing of consumer price inflation. But for commodities, for energy, for soft commodities, there, I think we're stuck. That type of inflation is going to stick with us longer.
Dan, I want to bring up consumption here because some of the data we're talking about earlier shows us that we still haven't normalized on the back of the pandemic, that consumers are still spending more. And there has been that security blanket of the built-up savings that many have had from stimulus checks. That said, we're talking about unusual patterns here where it's from mortgages, utility bills. There's so many different aspects here where consumers are now spending more than they would have anticipated. At what point do we see an impact on U.S. consumption?
Yeah, it's brilliant that you mentioned the excess savings, because that's exactly the reason why you can look at U.S. consumer confidence having dipped to levels that we haven't seen since the 1980s, and it not having a direct impact, us not seeing that in corporate earnings, revenue cratering. It would have to, with consumer confidence so low. And so what is the reason? How is it that consumers continue to spend with confidence so low? It's they've been drawing down those excess savings, and those excess savings are now gone. We've now just broken through the long-term trend, and we're back below long-term average on personal savings. So that's over. So I'm very confident that the actions that we've already seen, the hiking that the Fed, that the BOE, the SNB, that the ECB is doing, is already feeding through substantially to demand destruction. It won't take long until we start seeing inflation cooling quickly, because that savings, the helicopter money is now gone.